Okay, yeah, so welcome to this interview. I'm very happy that you would like to participate. I'm Ann-Christina, and I'm doing this study on the psychology of algo trading, and a subfield of that is high-frequency trading, and looking at how the different motivations that inspires traders might change with the new technology that we see is happening in trading practices. And to do this study, I have been following you guys for the last months, and I've seen you trading. And I'm quite inspired by this place and to see that there's so many different trading profiles. I mean, you have people with floor trading experience and doing hand trading, and also then doing algorithmic trading.
You've seen quite a lot here.
Yeah, I've seen quite a lot.
You've definitely seen quite a lot.
Exactly. And that's then why I invited you two to participate, because I think it's the most extreme approaches we can actually find here, that like you, Lucci, is actually doing hand trading, clicking on the button.
Right.
And then we have Ezra, a newly employed high-frequency trader, doing the quite opposite, actually, having automated all those kind of decision processes that I see you are making every day into an algorithmic trading model. So, and then actually, if you would start just explaining a little bit about the kind of trading that you are doing.
Sure. My trading is predominantly based on finding direction in the market from reading supply and demand, reading the shift in supply and demand in the market. So from all the players involved, whether they be smart money, institutional buyers, HFT guys, or people like myself, it's just kind of analyzing all that action and putting it together into some short-term directional move that I can make a significant amount of money on trading in the option space. And that's basically it. So it's a lot of price. It's a lot of price action analysis. So it's a lot of reading bid and ask all day.
Yeah.
All day on a slew of different equities.
Mm-hmm. And you're making those decisions instantly, right?
Yeah, well, I'm making those decisions dynamically based on what I'm seeing, and acting dynamically, after I get in a trade or after I make a theory, constantly assessing that theory and making sure that it's still correct theory. Mm-hmm. And there's support by let's say I'm going long, I see buyers on the tape, I see somebody else buying up that particular equity that I'm trying to take long, or vice versa on the short side.
Yeah.
Yeah.
So Ezra, could you explain then what you're doing?
Absolutely. Yeah. Sure. So basically I try to take advantage of the speed with which I can automate trading processes, and I try to be as non-directional as possible. Basically, I try to hedge out meaningful market motion and just capture by buying and selling the noisy motion in the market. The non-meaningful motion in the market will cause oscillations, which I hope to capture on both the selling and the buying side. And so I seek to make as many very low risk transactions, just buying the offer and buying the bid and selling the offer. So capturing the bid-ask spread. And basically it's a large number of very low risk transactions, which I try to drive. And I leverage execution speed of machines in order to do it.
Yeah. So could you say a little bit about who you actually interact with in the market?
Sure.
Because we hear a lot about this new trading practices in high-frequency trading, where it's algos speaking to other algos, it's the machine against the machine.
That's a tough question to answer there, Ezra.
Yeah.
Sure. Well, there's several types. I agreed. There are several types of order flow that I experience in the market. The type that's attractive to me would be large price insensitive orders, where you basically have a participant who is, as I said, price insensitive. So they are using, the markets I participate in generally are more about risk transfer than building ownership positions in stocks. So basically, I'm looking for a large market participant looking to transfer risk. They're price insensitive because obviously they're basically seeking to offload risk in one way or another, and willing to pay through the market. And I will capture the difference between the price that they pay and a price where I can lay it off in a short amount of time, basically. So that's the first type of order I encounter, would be large price insensitive order, and my suspicion would be that those types of orders come from large players such as banks or insurance companies, people with the need to transfer large amounts of risks, but basically, with the need for that kind of activity. I also encounter what I think would be informed order flow, which is basically when everyone in the market is following the same directional signal and the entire market moves, and I try to avoid that kind of order flow as much as possible. That is detrimental to my non-directional strategy. Okay. And the third type of activity I encounter that's easily identifiable is algorithmic activity. Okay. And basically,
how can you identify that?
Well, it's actually quite easy to identify, because for the most part, it will be strategies that are reacting to the same types of signals that drive my strategies. Okay. Oftentimes, the interaction amongst algos is analogous to a game of musical chairs, where everybody's reacting to the same signal or the same order flow on an instrument, and everybody is what's called leaning on a neighboring instrument where we all see an easy hedge. And it's possible and likely, frequently, that the triggering order basically was larger than the available hedge. And so you'll have a number of algorithmic participants all seeking a limited resource, which is the hedge. And the first players to reach that hedge will get it at their price, and the others will have to pay up. Yeah. And so it's easy to see, because when my hedge disappears quickly, basically, it's easy to tell that it's due to other algorithmic involvement. Yeah.
So, and then I can imagine that your trading practice looks quite different than what Ezra just described.
It looks extremely different.
Yeah. Could you try to explain who are your market participants?
Sure. Again, my market participants is generally the market makers in that underlying equity that I'm trading. They usually provide most of the volume, or they usually provide the liquidity for us to trade most of the volume in those stocks. So it's usually the market maker that I'm messing around with. But ideally, I'm looking for smart money flow. I'm looking for institutional flow, and I'm looking for sort of sector rotational flow. So, let's say your market is bullish. I'm looking for the names that all of a sudden there's a lot of money getting poured into. So whether it might be solars or banks or tech stocks or whatever it might be. And it might be different, as you roll through each day. So I'm basically looking for that kind of money, and just jump ahead of these guys and ride the sort of train. Yeah. So it's much different in the sense of what kind of environment that I do well in versus Ezra. So looking for sort of a non-directional market. I don't do too well in a non-directional market. There's not a lot of opportunities for me unless I switch up my strategies and act like a market maker, similar to what Ezra is doing. Yeah. So there's a lot of other challenges that I have to face, versus what Ezra is doing.
Yeah. And can you detect algos as well?
So for me, it's a little bit different. It's a little bit different, because since I'm looking for a pure directional trade, high frequency trading does not affect me as much as it does somebody like Ezra, where there's a lot of hedging involved, there's a lot of transference of risk involved, and there's fractions of a penny that he's looking for, or a certain bid or an offer that he needs in order to make a profitable trade, right? So for me, and he was alluding to being sort of price insensitive. For these directional trades, provided you catch it right, I'm pretty much price insensitive during those times too. So I'm the one sending those market orders, that somebody like Ezra would see an edge on because I'm hopping through the spread. You know, I'm hopping through the spread to buy those contracts that I need or to find the liquidity that I need.
Yeah.
And this also provides an edge to a certain group of people, and Ezra being one of them.
Yeah, absolutely. There's a sort of Heisenberg relationship
Right.
in trading between price and time.
Right.
Okay.
So there are times when you need to control the time of your transaction and price is less relevant. And there are times when you need a certain price and you're willing to wait. And time is at less of a premium.
Right.
Yeah.
So, you know, a lot of my market participation is done at specific price levels, and I will wait for those prices. You know, Anand will, you know, the immediacy of his execution trumps the level at which he gets filled often. So, you know, there's a, you know, a time and price trade-off, I think.
Yeah.
Yeah.
Okay.
So there's a lot of different dynamics that I have, especially in decision making,
Yeah.
that is completely different. So you
Yeah.
pick the two perfect people
Yeah,
to
exactly.
do your Jekyll and Hyde, you know, kind of study.
And it was quite inspiring because I hear that you are yelling a lot in front of the screen.
Oh my God!
You know, like,
oh yeah,
exactly.
it's very emotional. It's very emotional.
Yeah.
For me, it is very emotional.
Yeah.
And you know, everybody here understands, generally speaking, when I'm having a good day or when I'm having
Exactly.
a bad day,
It's very explicit.
or
yeah.
when I'm very frustrated, or whatever the case may be.
Yeah.
You know, so my style of trading is, again, it's very emotional.
Yeah. And who are you actually talking to when you are wearing the headset and who's on the other line?
Yeah, I mean, during the day when you see me wearing my headset,
Right.
like I run a chat room. I run a couple different chat rooms, which is part of the business that we run here. And you know, these are the folks that I'm talking to. So I'm sitting there just throwing out my analysis and what I see in price action for whatever sector that I'm taking a look at, or you know, whatever index that I'm taking a look at. So that's who you'll see me talking to.
So you actually share trading ideas with other participants.
Absolutely.
So you start imitating each other.
Absolutely, absolutely. So again, like my premise is not to tell somebody what to do. I mean, to me, that's the worst thing that you can do. But you know, guide some of the newer traders in there on what are some of the things that you really need to look at in order to make better decisions in your trading.
Yeah.
You know.
So Ezra, where does that kind of emotional level go in your trading?
Yeah.
That's an interesting question.
I'm very interested in this answer too.
You know, basically, unlike Anand,
Yeah.
who I think taught himself to trade,
Yeah.
which is it's very impressive.
Yeah.
You know, really, I was trained to trade, and you know, I had a very disciplined senior trader when I first came into the business. You know, who took an interest in me and my, you know, and trading like a discipline, and you know, basically critical to the way that that I was, you know, trained to trade is basically trying to minimize the emotion involved, and you know, I was trained by former floor traders.
Oh, okay.
Actually,
Okay, that's interesting.
it just so happens that the you know, the discipline that I was taught to bring to you know, to this you know, to this craft fit very well with algorithmic trading, which, you know, aligned with my background, and that's why I went into it.
Yeah.
But so basically, you know, to me, it's all of the decisions basically are made ahead of time. All of the decisions are general strategic decisions.
Right.
And the implementation, the micro implementation of the actual trades is, you know, is basically, for the most part, you know, predetermined in a sense, given, you know, market conditions, et cetera. So mostly what I'm doing is observing to make sure that everything is functionally correct,
Right.
and there are no unknown risks.
Right, right.
So the most rewarding thing to me on an intraday level is how my, you know, how my algorithm, how my servers are performing.
Right.
Basically, the only time that I'll show you know, that I'll show emotion is when there's some operational issue.
Like the internet goes down.
Yeah, something like that. You
Yeah.
know, and that, you know, that's trivial, and you know, I've learned now to have, you know, redundancies in place for that kind of thing.
Right.
But there's always something. Your clearing firm can have risk limits misset.
Right.
You know,
Right.
you know, there can be, you know, unforeseen conditions, especially with new strategies. But so basically, for me, intraday, you know, I do try and remain, very steady emotionally.
Yeah.
And I've trained myself not to, to minimize the feeling I get. Basically, it's much more. I try to derive reward from the trades, my strategies and algorithms executing properly, more than the day-to-day P&L. Because a successful strategy, the trend is always upward. The P&L trend is always upward.
Right.
So getting bogged down on intraday P&Ls can be counterproductive for me.
Absolutely. That's a much different world, And then you think of the floor traders that actually trained here. Remember, floor trading is super emotional. I mean, it was always super emotional.
And there's crowd dynamics going on
Absolutely.
there where people would actually affect each other.
Absolutely.
Yeah.
And you're talking about emotions. I mean, that is the most extreme that you can get.
Yeah.
Right? And all these decisions are being made on emotions. And then finally, I'm sure the whole industry hit this place where they foresaw that we're not going to be players anymore. This whole thing that we have here on the floor is not going to exist.
Sure. The successful floor traders, the floor traders who continued that success, had to see the electronic revolution coming.
They saw it coming, exactly. And the one thing that they all agreed on, whether they sat down and talked about it or not, was how do we take emotion out of the equation?
Yeah.
And that was it.
Do you know if there's no one who actually tried to translate that kind of emotions into electronic trading?
Well, it's an interesting.
Yeah. I mean, you're saying how do you translate that emotion into actual trading decisions?
Yeah, because it might be a productive thing as well.
It is, absolutely. I'm convinced, and maybe Ezra can attest to this, I'm convinced that the smart money of this world will track behavior and emotional behavior on the basis of where to find that edge, that, strategies like Ezra's and other HFT and other algo strategies can exist. Because when you have decisions based on emotions, and let's say you can study that, you can research that, you can figure it out, that's where you're going to find the most edge. That is where you're going to find the most edge.
Absolutely. All the best directional traders that I've encountered find a way to, I think that the emotion that we see is an outpouring that's ancillary to a very productive neurologic process whereby basically successful traders can empathize with the market.
Right.
Yeah.
And when you can engage that, that's when, you can possibly anticipate market emotion.
Right.
Yeah, because there's still that when you have to define the algorithm, right? You still have to define parameters for when the algorithm has to buy and sell and so on. So there will still be like some kind of intuitive process of how to read the market.
That is interesting. I was speaking more from Anand's perspective, where you have pure directional traders.
Yeah.
When it comes to my my non-directional market making design, I'm definitely cognizant of how crowd behavior could cause a breakdown in the conditions that I'm seeking to profit on.
Yeah.
But generally speaking, for the most part, my strategies don't take advantage of market emotion in the same way, for exactly the reason I was saying. Somewhere deep in Anand's mind, he has an empathy pathway that he's able to engage daily, allow them, to just sympathize with other people or empathize with other players in the market, and so he's able to anticipate how they're going to act in response to certain conditions.
Absolutely.
There's no way you could ever have a computer do that.
Yeah. Okay.
Absolutely.
Yeah.
Absolutely.
But do you feel that this new technology is friending your practice, or does it?
New technology, as in what?
As
a
in
higher use
like,
of algorithms?
Yeah.
Do I feel that it's
like
lessening or diluting my profitability?
Yeah, exactly.
I don't think so. I don't think so. I think it is squeezing it down to a much smaller time frame for me. I do think that is the case, because, and again, there's no way for me to prove this, because again, like, I don't have the analytical capabilities or the mathematical capabilities to extract all of this data and actually sit there and prove a particular theory that I might have. But I do think the increased use of algorithms in this particular market after 2007, I do think it has squeezed the profit potential for somebody like myself down to a much smaller period in time. than it was, let's say, 10 years ago, or was before the computers kind of took over market making. They took over order execution. They took over, literally everything.
I would have to guess that would be the case.
Yeah.
Because basically what algorithms have done for cross-asset price discovery, I would imagine makes basically, whereas say, Anand having caught, a good directional wave, basically whereas before there was, complete cross-asset price discovery due to algorithms, there may have been margin for error on the exit.
Right.
You may have had 5 minutes and the price wouldn't have snapped back on you yet.
Right.
You could have, even limited out or something.
Absolutely.
But
those kind of little nuances that have changed over time because of that higher use of algorithms.
Absolutely.
I do agree.
Absolutely. You're not going to find mispriced strikes the same way.
Exactly. All that little arbitrage that you could find 10 years ago, with mispricing and things like that, you don't find that,
Yeah. So would you ever consider going into algorithmic trading?
Well, the thought definitely crossed my mind.
Yeah.
It definitely crossed my mind simply because you're in a world where if you look at it logically, if you look at it logically, without emotions and without the ego, of one's abilities. If you look at it without all of that, and you take an edge, and you have so many dumb players, and you have so much retail money, and then you have mutual fund money, which as Ezra said, is very price insensitive. They don't care. They just want to allocate. They just want risk.
They want certain exposure.
Right. They want exposure, or they want to take off exposure. And whenever they do these things, there is edge there. There's a lot of edge there. But the edge only goes to players that can understand, again, the structure of the markets, have access to the speed, have access to that technology.
Yeah.
That edge is only for those type of players, So for myself to come into the mix and try to stake my claim with edge like that, it's not possible. It's literally not possible.
Yeah.
So I literally have to understand when there's big transference of risk involved, and there's just giant moves that happen in the marketplace within very short time periods. And that's where I live. That's where I can buy a dollar option and sell it for 10, and I can do these things within a very small time period, and I can make a huge chunk of money. So that's kind of where I exist. That's kind of where we've been pushed to because of everything else that has happened.
Yeah.
And there's plenty of other ways to play the game. I could essentially become a market maker. And I could do that without algorithms. I could do that without all those kind of things and still have a profitable strategy. But when you think about real edge, and when you think about a consistent P&L, when you think about no risk, and when you think about all these things and how in 10 years you can build, let's say, $1 million, turn $1 million into $10 million within 10 years, the best way to go about it, if we were to do that, would be the algorithmic strategies.
Yeah.
Because that way you can essentially insure yourself, without all that downside risk that I have to deal with all the time. I have to deal with drawdowns. I have to deal with these things. I have to deal with being wrong. I have to deal with emotions. And these are all things that can essentially destroy you as a trader. So if you can take all that out of the equation, I'd be stupid to sit here and say I wouldn't do it. But on the flip side, and I asked this to Ezra here, and there are many pitfalls of building algorithms as well. There's many pitfalls in the codes that you write. There's many pitfalls.
Absolutely.
There's many black swan events that can kind of throw you into the muck just as well as
Absolutely.
myself.
Absolutely.
And there's so many stories I hear of algorithmic traders. Their code goes wrong, or something happens in the market, and they either adapt or they get swallowed up by the next guy.
Absolutely. One of the hardest things is developing a system or distributed system that's intended to interact with with real world systems.
Yeah.
Okay, they go wrong all the time. That's why we're only now starting to see driverless cars.
Right.
Okay,
Yeah, of course.
we were nowhere near airplanes that can land themselves.
He's great with the analogies,
Okay.
by the way.
Yeah, definitely.
Thank you.
Yeah, so what you're saying is actually it's not as automated as we would like to think.
Well, the fact is we are automating it
Yeah.
completely, and the major risk is design risk.
Yeah.
Right.
And that is very difficult to, to quantify or predict.
predict.
Absolutely,
Yeah.
by nature, it involves, error, catastrophic scenarios. So basically, whereas, Anand will never put on, one of the, basic, dogmas of being a trader is never to put on more risk than you can handle.
Right.
And I'm sure he's trained himself at this point to that point where, regardless of the emotion, he will not cross certain thresholds that endanger him beyond a certain point.
Yeah.
He will, my motto has always been in trading, you live to trade another day. You
Yes.
never let one position take you out no matter what. Doesn't matter if you're algorithmic, doesn't matter if you're a hand trader.
Doesn't matter.
Okay.
That rule
Yeah.
stays flat amongst
Correct.
whatever
Across
strategy that
all
you
all
have.
of trading,
Absolutely.
regardless.
Absolutely. So that's one
Okay.
thing that we would have in common. essentially.
Absolutely.
Absolutely.
Absolutely. And but basically with algorithms, there is the capacity to engage the market with greater risk than you would desire or anticipate, because basically all the decisions are being made, very rapidly and by machines,
Yeah.
which we have entrusted with, with our capital and with certain, with the power to deploy that capital. And so, the major risk is design risk. It's
Yeah.
a significant risk,
Yeah.
and it requires very regimented deployment properties, procedures, and that is my absolute, greatest risk in,
So do you think that the hand trader will disappear eventually?
No, I don't think he'll ever disappear. Nobody will ever disappear from, no market participant will ever disappear from a place like the stock market. Remember, we're talking about pure capitalism here. We're talking about a place where anybody can exist provided they find some kind of an edge or they find
Yeah.
some kind of a strategy that they can manage their emotions, whatever the case is. There might be a situation where there's too many algorithms, and I'm sure you've thought about this. There might be a situation where things become too electronic, things become
Yeah.
too tied to
Yeah.
the machine, and something goes wrong. Something just goes wrong. I mean, it happened with the flash crash, and I believe that was kind of a small event, actually. Whereas there's so many different trends that happen in the marketplace. And who knows, microstructure could change in the markets with regulations that come down from the SEC once they
Yeah.
smarten up and they start sending people to jail and saying, no, you can't do this, and no, you can't do that. So who knows? But the point is that everybody has to adapt. Everybody has to adapt to the
Yeah.
new marketplace.
Yeah.
It's similar to hacking. Let's say you hack into a website, they get smarter, the website wants to block you out. So they change their systems, they change their code. The hackers got to get a little bit smarter, and they figure out a way back in.
Yeah.
So it's the same kind of thing.
Sure.
Yeah.
Not to mention which, the, asset prices, and, derivatives prices reflect, actual changing underlying value of the assets. And, basically, there's never going to be a point at which relative values of assets stop changing. Okay, and so basically,
Exactly. As long as you have a marketplace that is driven by emotion, you're gonna have price fluctuation.
Yeah.
And as long as there's that kind of fluctuation, there's always gonna be guys like me out there. There's always gonna be guys like Ezra out there.
Yeah.
Always, no matter what.
Yeah.
Unless we hit a point where there literally is no more emotion like that, and we're in a perfectly a priced environment, which hasn't happened since the existence of the whole market and any capitalistic market in since
yeah,
the beginning.
it's an impossible scenario
It is
to
an
ever
impossible
realize,
scenario,
Yeah.
So the only difference is that are you smart enough, and do you have the foresight to stay into the game? Whether you're an algo guy, whether you're
Yeah.
whether you're trading with code or whether you're trading without it. Do you have the foresight to realize that you need to constantly adapt to the ever-changing, environment that you have?
Yeah.
So no way will people like myself ever disappear. In no way will people like Ezra disappear.
Yeah.
You know, it's just a changing of it's kind of sort of a changing of the guard. That's all it is.
Yeah.
If you can remain sufficiently flexible.
Yeah.
Yeah.
You know.
You know, which by the way, most people can't. A lot of people can't. You know, and especially in my world, the hand trading world. You think about guys that especially pit traders, you know, these guys were the top dogs of society, of the stock market. And half of these guys don't exist anymore.
Yeah.
Floor traders, they don't exist anymore, you know?
Absolutely.
And they've given up the game. What have they become? They've become brokers, right?
Yeah, they went
become
upstairs.
Brokers, they went upstairs. They went upstairs.
Exactly. That's true.
Why? Because it's easier to make the commission versus making an emotional bet here.
And that's the lucky ones.
Right.
That's the ones who are able to reinvent themselves.
Exactly.
Okay, because they're doing a very different thing today than they were doing 10 years ago.
Yeah.
And everything, you know, the same, you know, one of those things, the same thing you hear over and over about successful traders who have been in this game, you know, who make a career of trading, which is very different from the way a lot of people do it. But career traders, everybody says the same thing about them after they've been in the game sufficiently long, you know, duration. And basically, they say, you know, it's always, oh, he's reinvented himself 4 times by now.
Okay.
You know.
Yeah. And not a lot of people are able to do that because again, there's so much emotional capital that you spend on being this one type of person.
And that business model has fed you for years.
Exactly.
You know.
You know, and to change yourself into this new being, you know, who has new characteristics or has new way of going about business, it's difficult to do, especially when you know something your whole entire career and you have to switch to this new person.
Exactly. And could you say a little bit more about how you trained yourself to work with your emotions when trading? Because now Ezra explained that he actually trained himself to be detached from that emotional level.
Right.
So I would be interested
Zen
to hear
master over here, man. I don't know how to do it. I honestly do not know how to do it. I mean, I've been able to do it to some extent. I've been able to understand that emotions are going to be a part of the game and that I'm going to go through swings. I mean, this is just the cost of me doing what I do.
Yeah.
You know, so I've been able to understand it at a fundamental level. But to take emotions out of the game like that and to act you know, appropriately in any situation without bias, without ego, without pride, without remorse, without all of that, it's an increasingly difficult thing to do.
Yeah.
It really is.
What is it that motivates you when you're trading?
Freedom. I think it's what motivates Ezra. I think it's what motivates everybody who trades. I mean, we have conversations. And the thing is, like, Ezra and I are not that different, you know, as far as what we want in life, you know, we just have a different way of going about it.
Interesting.
You know, so it's pure freedom. It's pure being able to do what we want to do and being able to be the people that we want to be, you know, and passing that knowledge onto our children and everything. Like, we have those same core desires. We have those same core wants.
I agree. The markets provide a certain kind of freedom to participants, which is also, you know, a certain kind of, you know, existential fear at the same time. The freedom and it's the same thing, I think Sartre would say, you know, basically, which is that markets enable you to leverage whatever your natural talents are.
Absolutely.
Okay.
Most directly into profit, more than any other occupation, where your skills would be assessed by some managerial group and you'd be paid some fraction of what your, you know, contribution is worth. Markets give you the most direct transference between your particular skill set and profitability.
Absolutely.
And so Lucci has, by all means, you know, Anand has identified what you know his particular skill set is, and that's what he's leveraging every day.
Right.
You know, and likewise, you know, I have a background in automations, you know, and you know, in developing you know, autonomous you know, algorithms, and basically, you know, what we're both trying to do is the same thing, basically leveraging.
And the worlds can coexist. You know, the worlds can coexist.
Yeah, that's
you know?
what we're seeing in this space.
Exactly.
Yeah.
You're just a different participant in a market that feeds and takes away from so many.
Yeah.
You know, so we can coexist without even knowing each other's existence. And
Right.
that's the beauty.
Yeah.
That's the beauty of the market in the first
Yeah.
place.
And if I may, also one thing that you were saying, it's interesting. The conundrum I think that I see in Anand is that obviously the emotion provides extreme benefit to what he's doing. It's an essential piece of what he does. What he's trying to do is not divorce himself from the emotional aspect. You're probably trying to filter the productive emotion from the non-productive emotions.
Absolutely.
Every trader has encountered non-productive emotion.
That makes sense.
Absolutely.
Exactly. Yeah.
And non-productive emotions can come from anywhere, But just the fact of dealing with emotions to begin with, it's a difficult task. And when you can strip those emotions completely and still make that money, I mean, you're talking about pretty powerful stuff.
And I'd be lying, I'd be misleading if I said that I, didn't experience any emotion. That's not the case. That's not human.
Yeah.
Right.
Yeah.
And so, I try and channel, both positive and negative emotion, into, work ethic, basically.
Right.
I just, I try and channel that into, working harder. Whether, it's actually much harder to channel positive emotion for me. When I'm winning, that's when it's most difficult for me to, to come back in and apply myself.
Same. And that further proves that human behavior is the same. Like human behavior across whatever human you're talking about, whether they're different races or different social backgrounds or whatever the hell it is.
It's a basic human.
It's human behavior.
Yeah.
And this goes back to my previous point where if you can understand human behavior at its root and how decisions are made in the market, that is the top of the world right there. That is the top of the world because you can literally move the herd. You can move perception. You can move the perception of retail money, mutual fund money, into doing all kinds of things.
Yeah.
And there's your edge. There's your edge. So I still believe like that's the root of. That's like the biggest money, or that's like the biggest place that you can sort of rise to.
Yeah.
I don't even know if it exists. I don't know if it exists. I don't know how to prove it. I don't know how to prove that
It's
it exists.
rumored, right? We all have our conspiracy theories that this was some big guy at one of the big banks on one of the high-level floors making a big move, or
a group of just
in the
traders
know
who just
individuals.
get it,
Yep.
who just get
Agreed.
it.
Agreed.
And who just move crowd sentiment and who have all the kind of time and money behind them to be able to do these things.
Yeah. Do you agree that you can sort of participate in the market and move that crowd sentiment also in algorithm trading?
Well, basically, whenever the market moves, and trading is frequently, a social endeavor. It's done on desks, open desks. When the market moves, the scuttlebutt begins as to why.
Yes.
Always.
Yes.
Yeah.
And one of the dominating theories, generally speaking, is somebody knew something, right?
Yeah.
And basically, what that means is that somewhere there's capital that knows something before we do, and they're acting on that.
Absolutely.
And that's
That's exactly what I was alluding
And in case it's not already obvious, my style of trading depends on lots of participants like Anand.
Exactly.
Okay, basically disagreeing on what
And where there's that disagreement, there's that actionable decisions that can be made off that confusion.
Yeah.
Which by the way is I would say 80% of the market environment. Most of the market environment is just pure confusion. Very infrequently do these major big picture moves happen in the market where everything moves in unison.
Yeah.
And if that does happen, it happens on the backs of somebody losing a lot of money or a group of people losing a lot of money. Yeah. And that's where those big pushes happen. The rest of the time, it's the world for guys like Ezra. It's the world
that's actually
for
interesting. So it would be fear. It's when people they're pulling out that you see the big moves. It's not when the market is going up.
And interestingly, you can see, there's panic buying as well.
Yes.
But what you can see, interestingly, often, not infrequently, is on these large moves, you can see several stages to the move, right? There's the initial break out of the range.
Yes.
Then there's bandwagoning effect. Battles.
Yes.
Then it'll hit some stops once it hits a certain range, and you'll see an ignition.
Yes.
Okay, and basically, there are disagreement points at every resistance.
Absolutely.
Yeah.
Absolutely.
But you would have different ways then of benefiting from these movements, right?
Well, I would assume, and again, like I'm actually interested to see like when this big transference of risk happens, and let's say your strategy is predominantly based on,
The steady state.
the steady state.
Sure.
When this big transference happens, do you shut it off?
Absolutely. I mean, basically,
You shut it
okay, so basically when these kinds of events happen,
Yeah.
and it's critical, just as much as knowing when to trade, knowing when not to trade is critical for my algos.
Exactly.
So, the minute that there's a breakdown in the steady state, which is the situation I'm seeking to take advantage of, absolutely, my market making algorithms, they're tuned, and that's where the speed difference makes the biggest difference in high frequency trading for me. Being co-located, having the fastest information, it's to know when there's a meaningful move, an informed move,
Right.
and absolutely get out of the way.
See,
So,
and this is where the two parties marry, because if you think about my strategy, right? If you think about my strategy, it starts making money when his turns off.
Yeah.
Imagine what is the mathematics? What is the mathematics behind the understanding of when to turn these things off? What is the data to prove that this big move is going to happen? This informed move is going to happen.
Yeah.
Because I'm trying to look for that informed move. That's what I live for. That's it. That's everything. And if the two could sort of get in a sort of a cohesive relationship,
that's
you
extremely
essentially-
attractive.
You essentially have,
That's quite interesting.
you have a strategy for everything.
Yeah.
Absolutely.
So you're really diversifying your risk profile.
Absolutely.
By having these
A
different-
successful hedge
essentially
strategy.
what Ezra could do would just be like, Lucci, go. And that's all he
Yeah.
has to say, right? And as soon as he says go,
Sure,
I'm there.
Lucci, we have a high degree of confidence
You know what
that
I
this is
mean?
an informed move.
So, there's marriage between the two worlds, and
Yeah.
remember, they're both looking at the same market. They're seeing the same things. We both
Yeah.
see the same things.
Yeah.
But we articulate it differently because of the knowledge that he has and the knowledge that I have. But we're both seeing the same things.
Yeah.
And we're both trying to stake out a claim on the same things that we
Yeah.
see. But it depends on your capabilities, it depends on your technology, it depends on all these things
Yeah.
that you can hopefully influence to get yourself that
Yeah.
edge.
So when speaking about market psychology, how should we speak about this now? Should we speak about different psychologies of trading, like electronic trading is like one psychology, floor trading is definitely another kind of psychology. We have people sort of against people, we have the human against the screen, and then suddenly we have like the machine against the machine. So would we have 3 generations of different trading psychologies?
I don't know, what do you think, Espen? I'll take this one after you, I'm interested.
Oh, fair enough. Thank you. No, it's obviously an excellent question. Basically, I'd say the predominant effect of algorithmic and algorithmic trading is in a market making capacity. I would, the majority of market making before electronic emergence was done by local traders.
Right.
Basically, floor traders, designated market makers, individuals on the floor. So, basically, that is not by all means, that is not by any means all the activity. The market makers live, and exist to serve the directional traders in the market. So what moves markets is still, and will always be directional traders with directional exposure coming on or going off.
Yeah.
Whereas prior to that, there was a market structure that was dominated by humans in the pits doing the actual execution. I'd say now it's probably dominated by machines. I think that, so there is a certain, there's this one aspect now, the market making execution side of things that, where the dynamic has probably changed significantly. That means, basically that the market structures in certain products, possibly all products, there's a certain psychology that's, been replaced by this, efficiency-seeking group of algorithms, which are all probably very similar and behave very similarly. And so, we can expect a certain amount of efficiency in place of, you know, noise, you know, which is what the pits provided, but, you know, execution got done. And now basically it's more efficient. It's like, you know, ATMs instead of, you know, going to the teller at the bank when you want your actual execution. So, you know, it removes a certain dynamic in trading, but
like I said, he's got great analogies. I don't know what it is. Do you just whip them out? You don't even think about it?
I have nothing to do all day
just-
but
it
watch
just-
my algorithms and imagine the analogies to share with you guys.
Great one, man. I would agree completely, and I'm going to try it. Do you mind? I'm going to do this analogy.
Go for it. Let's have it. Yeah,
Do you mind?
by all means.
So, poker, right? Poker. And all of a sudden, you remember Party Poker and the Poker Stars, right?
Absolutely, of course.
And all these boutique sort of online poker sites just popped up.
That's right.
Because it was this huge influx of just dumb money.
This is already a good one.
That one,
I'm telling you, it's already a good one.
dumb money, right? That just wanted to play. They wanted to play. They heard stories about somebody turning $5,000 into $50,000, right?
Sure, there are all kinds of participants who are looking for a lottery ticket, which is
Exactly.
incidentally the wrong mentality to take into trading ever.
Completely wrong mentality, but it exists. It exists. That mentality exists, and it exists pretty proficiently.
95% of retail accounts
Absolutely.
are probably because somebody heard about a friend or a friend of a friend hitting a lottery ticket.
Absolutely. So you take a dynamic, you take an industry like this, right? And then you look at the growth of that particular industry, okay? There was so much dumb money that had Party Poker accounts, Poker Stars accounts. And then all of a sudden, everybody got smart. Everybody got so smart. Everybody read books about poker strategy. Everybody read about the biggest poker players in the game, the Doyle Brunsons of the world, the Phil Ivies of the world, right? They all had their books. And everybody became so much smarter. And that edge just slowly went to nothing, right? And then obviously the bigger players still existed. Everybody still plays poker. But that juice there was just not there anymore. So when you talk about like crowd psychology and things like that, you know, that has a big dynamic. That's kind of the same thing. It's a similar thing, where now you have much more intelligent players here in the market. You have much more intelligent players that are capturing that edge that everybody was looking for or trying to figure out how to get. You know, so you have a much more informed marketplace, and therefore you have so many retail traders that still want that edge. They still want that edge, but they literally can't get it. They can't get it. They can't get it because every time they get in there, there's people scraping that edge from every single decision that they make.
Yeah.
You know?
It's very thin. They'd have to take bigger risk.
Exactly.
You know.
They had to take bigger risks. They have to become like myself, so to speak.
Now, sticking with your analogy, if I may.
By the way, was that a good analogy?
You're right on. I knew it from the beginning. That's why I told you. Yeah, excellent. And sticking with your analogy, because I think it's rich.
Yeah.
How much of poker do you think changed when you were no longer looking your opponent in the face?
Yeah, exactly.
How much did it upset when the first, electronic online player got a bid to the final table
Exactly.
Yeah.
in, the Poker World Series?
And you're talking about a world that existed because of this big trend shift. You're talking about bots. You're talking about even algo type styles that were developing bots on how crowd psychology in poker was going on.
Yeah.
And you could duplicate your machine basically to 20 or 30 or 40 or 50 tables. Instead of playing on one table, you had to sit there on a live table and look at somebody in the face. And now you could do this over 50 tables just using the psychological dynamics that you taught your program, you taught your machine, you know? And that's kind of what existed. So I feel like we're sort of in that same place right now in the marketplace. So there's just this big shift towards more informed players. And those are the ones that are scraping every little bit of edge that there was left in the marketplace that we saw.
Might it be that the increased use of algorithms might have an amplifying effect of the sort of power dynamics happening in the market?
Okay, so you're saying that when sort of these crowd dynamics shift and there's this big sort of emotional thing, you're asking if algorithms exemplify or sort of exaggerate that particular move?
Exactly, yeah. Because
Wow.
we have increased speed, we have increased volume.
Wow, that's an interesting.
Could it have that effect?
That's an
At the
interesting
same
conversation.
time,
I do believe it could. I do believe it could. When you look at, let's say you look at news algorithms. Let's say you look at big picture sort of event algorithms. So when Fed minutes come out or something, and there's those that get that information within milliseconds after that information comes out, right? And the public only gets it maybe a minute after it gets out. But you always see this giant .001 sweep here in the markets. You're talking about 6, 7 handles in the SPX, which can't be done by any human whatsoever.
Exactly.
You know, so in that sense, is it exaggerated? You could say yes, but from a pure emotional standpoint, I don't even know how to attack that question. Ezra, help me out here.
You know, from what it's certainly an allegation, that is, frequently proposed against algorithmic trading is that, they'll exaggerate what should be normal swings, et cetera, et cetera.
Yeah.
They'll preempt moves.
Which goes against the idea that you should make markets more efficient, right?
Well, actually, one could argue that it is making markets more efficient by having price snap to a new level as soon as the information comes out.
Yeah.
But at the same time,
So it's two arguments that's being placed that somehow
Sure.
goes against.
sure, but that presupposes that the motion is actually due to algorithms, and this I think relates back to trader superstition, and traders tend to be a superstitious bunch.
Oh my God, we have to be.
Basically,
We have to be.
yeah,
'Cause how else could we
when the
explain
source of
it?
your success is so ephemeral, it's
Exactly.
natural,
Exactly.
and so basically, the same way that traders will theorize that a big move was caused by some informed pool of trading large amounts of capital, traders, I think it's the same superstitious nature to claim that it was the algos that caused a certain move or whatever.
100%. 100%.
you know.
And by the way, that's proof of what you see on Twitter now. Anything unexplainable, it's the HFTs did it.
Yeah,
It's the algorithms did it. It's this is it's similar to writing off somebody as crazy because you don't understand them.
Yeah.
When you say somebody's crazy, that's dismissive. You don't know what's going on. You just say, they're crazy, and you just throw it in this basket here.
Or it could be a fear of the machine.
Yeah.
I mean, we've seen that before.
Yeah.
like
Sure,
the fear
we
of-
fear what we can't understand. That's natural.
Absolutely.
So sure, so relegate it to HFT. Before we were relegating it to the floor traders knew something. There's always I've heard stories about how when the Fed minutes were getting released on the floor, the Goldman guys would get a phone call first. They would always know first, and and they'd be the first ones to move, and so
But hold on, you would be hard pressed to prove 100% accuracy that they don't exaggerate moves, though, because when there is crowd dynamics there, and when there is that big move, there are also buy programs behind it. There
100%.
are also algorithms
100%.
behind
So
it.
that's an excellent point. And so basically, there are two ways that I can see algorithms potentially exaggerating a move. One, which is probably the most direct, straightforward, and obvious, would be that they get the information, they process it first, they make a guess, and they move. And that's where you get these moves that happen coincident with a number, and that's probably it's got to be. It's I could see successful business models based around taking directional risk around numbers, being able to react based on thresholds. I'm sure it exists. Now, that's the most, that's the most obvious way that they can potentially exaggerate moves. Absolutely. But I think that there's another way that it's more, that they have real potential for actually exaggerating moves. That's a little harder to see potentially, which is through cancellation on the other side of the move. Right, by removing liquidity, and they could very well remove liquidity on both sides of the market.
I mean, come on.
But that means
they have to.
absolutely, and we're Was that happening before when it was locals? The same thing, absolutely. Before a number got released, the pit got silent, which is the same thing.
Right, because you think about this. You think about this is purely going back to what we've already been talking about. Is there's a point at which Ezra's algos will shut off, or he wants them to shut off, right? And if you have this news of an informed move about to happen, and you're supposed to provide liquidity, right, to those who want to play that move, there are certain times where you want to provide all the liquidity in the world, and then there are certain times where you just don't, but you're required to, right? So you're required to, and you immediately hedge. And you also add juice to that actual move, you know? You also add a little bit of exaggeration to that actual move. Why? Because you had to sell everybody that liquidity. You had to sell everybody that because you're required to. Yeah. And you can manipulate it a little bit. I mean, market makers have a little bit of leeway on what they can and cannot do. They have max allowable spreads, right? They got
100%.
They got little things that they
absolutely,
can do.
Which they will take advantage of during those scenarios. That's what it's there for.
You know? But if I'm a market maker, right, and I have to provide liquidity when I know there's an informed move, what do you think you would do?
Right, it's understood.
Get the hell out of the way.
Absolutely, absolutely.
You know. So there's that piece of the equation that, again, it's difficult to prove it. It's difficult to say that this is exactly what happens and this is exactly what those market makers do. It's difficult to throw that out there. Yeah. But when you're looking at pure logic, when you're looking at pure business model and pure profitability for X, Y, and Z business model, that question comes to mind. That question does come to mind because it's something that you would naturally do.
Yeah, there's a conflict of interest naturally for market makers in that scenario. You know, the market maker basically is, they're forced to take risk. Right. When they're forced to take risk when there's no one else to do it, and they are contractually obligated to do that. And as a result, they're compensated basically by getting first look at all order flow. Right. That's the traditional market maker model. Right. There are slightly different offsetting benefits, et cetera. Usually it's a fee structure that changes, but you do commit to providing liquidity both sides of the market at all times, especially and even when there's no one else there. And so when that happens, when you are the liquidity of last resort, you're in a natural position of conflict there because you're also trading for your own account. Right, so at you're responsible on one side to maintain orderly markets, and on the other side, you're responsible to, your backers to provide them as much, return as possible. And there's a natural conflict at that,
And think about the conflict with regulators too. When they look at a situation like that, or when they look at a theory like this, I mean, how do you charge somebody that is required to provide this liquidity? With malpractice because he does X, Y, and Z? How do you do that? How do you do that? Because without them, I wouldn't be able to make. I have to steal money from somebody. I have to take money from somebody, right? If they're not there, who the hell else is going to sell me the contracts that I need to make the money that I want? Who is there to do that? Yeah. So they have to be able to stomach that risk. By doing a lot of things, by hedging, by all these kind of.
But it's a very good point that you bring up. Basically, in the light of those large moves, the liquidity providers are forced to hedge.
They're forced to.
And that hedging activity, informed hedging activity, will move markets just like everything else.
I mean, I witness this all the time. I witness this all the time.
Especially in the options markets.
Especially in the options market. I can't put a phrase to it. I can't put a definition to it. I can't put it out there online and say this is what's going on. It's not like an option. You're not going to go to your investments class and learn about X, Y, and Z. You're going to learn about what a call option is and a put option is. But you're not going to learn about this part of the equation here, this sort of conflict of interest, which him and I are extremely interested in. Because our livelihoods are based on that conflict of interest.
Absolutely.
And I guess that's a whole different level of the psychology because it's within the market microstructure somehow, and you have to navigate in that.
Right.
Which is not only about the psychology of the individual trader anymore. So we have a psychology that is being expanded or distributed across a big network. Yeah, that works in a
Absolutely.
different way, I guess.
Absolutely.
Yeah. So I don't have more questions. Thank you for
All right.
participating.
All right.
It was
Well,
great.
thank you very much. We had a good time.
Absolutely. I learned something.
Yeah.
Thank you very much.
Me too.
Okay.
Thank you.